All right. Thank you all for tuning in. Welcome to this week's presentation. I hope everyone's having a decent week in the market so far. For those of you that are regular Shark viewers, welcome back. For any new viewers, we hope you get something out of this and you continue to tune in. Now, we are aware that everyone has a lot going on. You know, we're getting close to the holidays, Thanksgiving, Christmas, so we get it. Just know that we really appreciate you guys spending the next 45 minutes or so with us. So go ahead and type a Y in the chat if my audio is coming through, all right? Awesome. Thank you, guys. And everyone is seeing my screen, correct? Cool. Thank you, Richard. Thank you, Jack. Okay, so for those of you who are first-timers, my name's Ty. I'm one of the guys here at Shark Indicators. I've been with the company for a couple of years now, and it's just been an awesome experience so far. I've learned a lot. We've been involved in the NinjaTrader ecosystem for over 5 years, and we developed some of the most capable trading tools in the industry. Now, that being said, you've got to put in the work to hit your mark, right? That goes for anything you do. So let's take a quick look at the risk disclosure. Take a minute, look that over. Futures, foreign currency, and options trading contains substantial risk and is not for every investor. So, as I said before, we don't sell any holy grail this or home run that. We just build powerful trading tools. Now, on top of the documentation and weekly workshops, we like to show our audience what other NinjaTrader vendors and educators are doing with our software as well. So what we do for events like this is we bring in our partners and educators so you all get some variety and exposure to different trading methods and personalities, right? So each one of these presenters is successful in their own right, and each offers a unique trading style. So let's dive into today's topic, which is trading for probability with World Cup trader Rob Mitchell. Now, real quick, Rob is the president of Axiom Research and Trading Incorporated and the mother company to oiltradingroom.com and indicatorsmart.com. Now, Rob has been the largest E-mini S&P trader in the world at various times and has won the prestigious Robbins World Cup E-mini Trading Championship. He's been a trading system developer for over 2 decades, and he's an early adopter of our Bloodhound software. And on top of all that, he's a proven trading educator, presenter, and a mentor in the ecosystem. So let's just get right into it. I'm going to go ahead and pass the mic and the screen over to Rob Mitchell.
Hey guys, can everybody hear me all right? Let me see if I can find our monitor. Let's do that guy. And yeah, how's everybody doing today? Man, see a lot of familiar names. Welcome, welcome. Thanks for coming in today, guys. Thanks, Ty, for that introduction. I decided last couple of webinars, we did some Bloodhound coding. And so I decided this time to kind of go into a little bit different area that gets you thinking, because Bloodhound is a system development tool, and just to get you thinking about some ways that systems can be put together and designed, and just kind of the way you think about them, and the way that you can identify patterns that you can code into Bloodhound and know what the outcomes are going to be on those things before you code it. Because a lot of times in this process, it all ends up getting done backwards. I coded my first systematic trading system in 1991, and this is back before, I'll let you guess how old I am, but this is back before they even had trading software. I think, yeah, it was before there was any trading software really. There was I can't remember, there was a trading software, but it was kind of like this modular thing that you couldn't really do a whole heck of a lot with. But I was downloading data from a Prodigy database into an old Borland Quattro, or not Quattro Pro, it's called a Paradox database, and I was coding up trading systems within the database, and I started way back then, and just looking for things like basing patterns and different statistical things, and It's come a long way since then, and the software that's available to us now has really come a long way. So a lot of what I'm going to talk about today relates to the design of trading system, the kind of thinking that goes behind making a successful trading system, and also at the same time these same concepts go hand in hand with trading because they're synonymous with, or they work together with. So we're going to mess around with some ideas, using some big terms. I don't really like to use some of these terms. I don't like to use that word probability, really. It can be a scary term. But I'm going to show you probabilities that are just done so simple, it's simple. And then this other word, conditional probabilities. That's a fancy way of saying, well, if this certain thing happens, like if we hit a value area high, or and then this thing happens following it, then do it. So it's just simple. Just simple. That's some big words. That's what these things are called. So, but I'm going to show you how this, where this notion comes from, and talk a little bit about the history of that and where it came from and stuff like that. So that's fun too. But as you take all these ideas that I'm going to give to you today in pretty high density, you can take these things and get them integrated into your own consciousness, so that when you're either designing trading systems or trading, etc., you can use those to your advantage. Now, Ty had already covered the disclaimer, so I won't spend a lot of time on this, but trading, it's always best to use money that you can use as risk capital, because trading's a process, and a lot of what we're talking about today is a process. And so if you are trading the money, you're going to go into crowd-oriented kind of thinking, and that's what we're trying to get away from here. So always trade with money you can afford to be playful with, and it opens up the door for being in the moment while you're trading and enjoying the experience and everything else. So sometimes people ask me, well, why do you do this? Well, I enjoy it. Number one, I started a trading room. We're a little over 3 years in our history now, and it's been the most humbling and rewarding experience I think I ever could have done, just helping traders and just kind of expand their awareness and be familiar with some of the kinds of ideas that we're talking about today, and trader psychology and everything else. And so it's just been really rewarding to me. I've been fortunate, as Ty had mentioned, to be able to trade some substantial size over the years, and to win in some trading championships, and been around in a business where most guys only last about 3 years or so, and I've had the fortunate ability to make my living as a trader for better part of 20 years. And so it's just my way of giving back. It's also, as I said, it's also humbling because I continue to learn in a really deep and profound way. I have a degree in experimental psychology, which relates to statistics and experimental design. So a lot of the ideas that I bring to the table are related to this kind of thinking. What are valid kinds of ideas that we can test, and this sort of thing. And Ty had mentioned I have a website, oiltradingroom.com and indicatorsmart.com, and we also have a trading room run by Steve Myers, stock index trading room, and that's what we do. So, without further delay, let's just get right into this. So here's some of the things I'm going to cover today, just kind of looking at the big picture. How do you break your trading into structured chunks? Because when you know what those chunks are, then you're aware of what they are, and it helps you to understand how a trade setup. A lot of times traders just talking about setups. Yeah, but once you're in the trade, how are you going to deal with that? So, and so I'm going to talk a little bit about, okay, once you're in a trade, how you can get to, if you want to, how you can get to a break-even status and go for those runaway trades that are important. So we're going to talk about how that's important too. I'm going to talk about how subtle differences in your trading approach can make you or break you. And this has been a thing for me over the years. It's just a real small difference in the way you're approaching the whole thing can make just a huge difference. So we're going to get into that a little bit. And I'm going to show you some high probability setups and how to test them and how to get into runaway trades. I'm going to show you some confluence. It's just another way. Confluence is another term for a conditional probability. You got a couple things happening at a time, and you look within that kind of context of what's happening. So, and how to combine those known probabilities. And sometimes I look at it as pushing or pulling. Is this pushing or pulling my trade to success? So I might look at it on each side and combine those together in a kind of confluence that's not necessarily, a lot of times when people talk about confluence, it's like two lines that are like overlapping on your chart or something, two levels of support or resistance or something like that. I'm going to show you how to use confluence in lines that are not necessarily touching, and the zone between them ends up becoming a place of movement on the chart, or at least with some known probability. And how to determine when the majority is long or short on a walk forward basis during the day. I've also learned over the years that, and as I've gotten older, I don't really have the energy, that I did when I was 20. And so I like to break things down into chunks that are easy to process, and it goes hand in hand with what we've been talking about from the beginning here today. Breaking things down into chunks so I know I don't need to analyze the thing again for another 25 minutes or something like that. And that's very comforting too, and it also helps to keep you in the moment. You're not all caught, you're like, I don't need to look at this for another 30 minutes, this kind of thing. And then I'm going to show you some setups that that you'll like and that you can use starting today. So this thing is called a Gault and Board, this image here. And basically it's just a bunch of nails in a board with a little like sieve on it, right? And you drop the marble in there, and then when it drops down to that first nail, it's 50-50, can go to either side, right? Then once it goes to there, it's going to fall to that nail or that nail, right? Now from that nail, it can fall to that nail or that nail, or that one it can fall to that one or that one. So each of those is 50-50, right? And then say it falls to that one, it's 50-50, then it falls to that one, it's 50-50, and it makes its way through. Maybe it can even go all the way down, boom, and end up over here. So you're like 1, 2, 3, 4 bins from the middle. You're the fourth bin from the middle. And I labeled this the losing side, and this is a winning side. So this is an example of a trading system that has 50% win rate, as every one of these is 50%. And so this is just a real simple way of understanding what in statistics is called a binomial distribution. It just means, okay, every time you get to a decision point in this kind of tree, it's 50-50. A thing that I want to spend a minute on is where a lot of smaller accounts often get into trouble with this, but it has a big effect on your trading. So if you take 10 trades a day at $4 a round turn, that's $40 a day. You do that 5 days a week, it's $200 a week. 50 weeks a year, it's $10,000. Now, brokers know this, and they know that some guys will click a lot more than that. I've done it, you've done it, everybody's done it, right? And they also know that the smaller the account is, the more likely it is that this kind of thing is going to be happening. So imagine, if that account's like $2,000 or even $5,000, you're losing 200%. Well, actually, you're losing it all, right? You lose 100%, but you're actually spending many times what the account size is, and that's just in the commission. That's not slippage or anything else. So, and smaller accounts tend to trade more because they're trying to hit a big home run, trying to hit that big one. But some of these concepts I'm going to show you today can keep you from trading like a wild maniac. Maybe trade a couple times a day, maybe 2 or 3 times a day, and get that stuff under control. Because this thing, you don't really notice it. Well, it's not on your screen, right? And so it just kind of just a little. It's like the bathtub. You know, you turn the bathtub on, you forgot to put the drain in it. Forgot to put the drain plug in there, and you come back 20 minutes later, you're like, I know it takes 20 minutes to fill up that tub. You come in there and there's this vortex going down the drain, right? And so it's real important to be managing this side of the equation when you're looking at trading. So, but if you do what was on the prior screen at a high win percentage, and your average trade is larger, then that expense becomes really negligible. But if you're back there on the Gault and Board doing 50-50, a break-even trading, then you know you got a problem. So you need to have an equation that overcomes this thing. So you know that opens the question: what's the minimum trade size you need to go for in order to make this whole thing work? I work with a lot of traders, and a good number in general is that your commission cost should not exceed 10% really of your trading activity. Should not exceed 10%. So you know, if a trade is commission's $4 rather. You should be making at least $40 a trade on average. In order to hit that number. If your number is digging more into that, I mean, if you're batting like, you know, 20, 30, 40% commission, you got a problem going on. But you can always go back to that formula. Okay, well, what if I annualize this? What's that going to look like? You know, just multiply it by 5 days a week, and oh, I traded 20 times today. Oh, it's $100. You know. Okay, that's 500 a week. It's 25 grand a year. You know, and kind of put that into perspective, and that kind of really helps you in trading because it helps you to put the brakes on in the right place. It's like, ooh, I need to be smart about where I'm firing trades. They need to not be indiscriminate. Those little $4, $3, you know, 60 cents or whatever it might be, they add up. So for today. And just to keep it simple, because I'm going to show you some examples on a smart Renko chart, and that chart is the bars are 10 ticks, but the continuation bars on there are 5 ticks each. So all we need to do is be able to see that it went 2 in our favor, and we know it's good. So this is what I call kind of like your minimum, and that's also within that commission thing that we're talking about too. Oh, if I can get 10 ticks out of the trade and it cost me $4 to do it. You know, in a $10 per tick market, you know, I made $96. You know, so that works, right? So we want to find out how to get in trades in the leftmost win slots on that Gault and Board. And I'll take a look at that in a second. I got another one here. I'm going to show you some. And later on, I'm going to give you a spreadsheet that'll show you how to get some super high historical win percents and trade situations where the majority is likely to be propelling in your favor, but then into that runaway. So it's like, okay, I know that I can hit 10 ticks, you know, 84% of the time, and I get into a runaway, you know, 5 times a week. It'd be something like that. So this is the Gault and Board again. This is the win side, this is the loss side. And so if you were to have this thing and start dropping marbles down into this guy, you'd find these things will start piling up over here. It's called a skewed distribution. So the peak would end up over here, and it'd kind of go out tail here, and it'd be almost nothing over here. Possibly nothing at all, depending on how far you tilted it, right? So when you do this, it's real important. And the reason I show you this in this graphic kind of way is because it's really easy to understand, right? It's like, ooh, yeah, it's fallen to the right side of the nails. And so what happens when you do this is the win percentage starts dropping, because these are losers over here, and so you're dropping more into these bins to the left to center, and then your average trade also goes down at the same time. It's a double whammy. It's a double whammy. You're getting a lousy win percentage, and you're decreasing your average trade at the same time. So this is a real important thing, and this is where the money gets made or lost. As earlier I was saying, oh yeah, if you can just kind of hone in on that little tiny difference that makes the difference, this is one of those places where it really matters. What you want to get into is this guy. So the losing trades over here, and you end up with only a little bit in these bins over here, and you end up with a whole lot in these bins over here as it goes through the sieve, right? So what happens on this side is your win percentage starts going way up, and your average trade starts going way up, because you're going to start getting them way over in here. These are big winners over here. There are fewer big winners, and there are more smaller winners. And then the losers, man, you know, how about if we just tilt this thing on end so they all fall down here into this bin over here? That'd be 100% winners, right? 100% winners. So so you get a double whammy on this side too, right? So for every little bit that you can milk this this thing to skew to the win side, you're picking up profit at like a squared rate. It's not linear. You're just like, because you're getting it double, right? So really today's webinar is kind of about, I like the way this one was skewed, and they did the shot. I got this off of Wikipedia, and thank you to Wikipedia for being there. So so today we're really talking, in a lot of ways, we're talking about how to smash this thing and lift it up. But this brings up another point, because this kind of distribution will give you what's called a normal distribution. In other words, it goes down gradually on each side. Goes down gradually on each side. You could construct this this Gault and Board so that it would stack up way more in the middle, and it wouldn't get as many out on these outside tails. And but this this board, as it's constructed right here, follows this. This is 50-50 win. There's 50-50 on each nail. Some of them end over here. Some of them end over here. But what happens is you get 68% of the trading activity happens in the middle of these things. So like if this was your stop loss right here, then theoretically your gains would all occur over in this 13.6 and 2.1 and 0.1% of the curve. In other words, if your biggest loss is right there and the distribution went like this, you chopped all this part off on the losing side, and you're going to pick up 13.6% that you don't lose, and then over on this side you're going to get all this winning activity. These two will just net out to zero, as this is 34% of your trading and this is 34% of your trading. And so you only become profitable as you get over on this side. As you get over on this side. And so that's why if you tilt this guy, this side gets smaller. It starts smashing this line over towards that that center line, and it starts making these bigger, you know. And so this is what you're really trying to do when you're trading. And we're talking about this in a kind of an abstract way. But if you understand that this is what you're doing, then it opens you up for some cool kind of thinking. And so this is what you call a peak distribution. The Gault and Board, or this distribution, is called like a bell curve. That's what they call it. It's a normal distribution is what it's called, or a binomial distribution off of the board, right? Binomial just meaning bi. Okay, new decision. Okay, buy, meaning like two sides, like a bicycle, right? But then we get this guy right here. Usually when we're trading, we're dealing with peaky distributions like this. Notice this one doesn't just curve up real nicely. It gets really kind of peaked out. As you tilt that board over, what you do is you end up making this losing side of the curve real kind of steep and short, and then that other side kind of spans out. And so what you get on this guy is you get a high win percentage, and the amount in the losers is small, and this distance between where you're winning, because these two just subtract out, so you get everything on this side of the curve right here. And so with those kinds of ideas laid as our foundation, let's go start taking this to another level. So how do you break your trading into structured chunks? So step one that you want to do is to define a basic win percentage for any given setup. Now, these kinds of things can be hard to find, but if you've been doing it for years and years and years, you just start finding all kinds of this stuff. Once you kind of break through the ice on it, you start. But some of the setups that I'm going to show you today get you into these, and maybe that'll get your creative juices going for finding some others. And if you find some, you can share them with me, and I'll give you some feedback on them. So I'm going to show you some of these setups, and then I'm going to show you a method that's real important because it helps you break your trading into chunks that are defined so you can plan and understand what you might call the landscape or the territory that we're trading in. Okay, so if you know what that looks like, then when you click the button, your heart rate doesn't even change. It's like, oh, okay, this one's 85%. All right, if I get nicked on it, so be it. And that way you don't get drawn into that whole crowd mentality, or where you're clicking the button and you go into a panic attack because you've lost so many times. We've all done that. So I wanted to take one pattern that's very common, and I wanted to use it because it'll be really familiar to most of our people attending today. And I just wanted to use an example of how this can help you to see what doesn't work. It might have worked in the past, but how it doesn't work. And so we're just going to look at a chart, and we're going to look at some simple divergences, and we're going to just create a stat on it, just real simple. And so, and then I'm going to do another pattern that we've been doing for a long time, and oops, I keep shifting this thing around. And then I'm going to show you some other ones. But, I got like a dozen of these that I really like that run between about 68 and 89% win rate. And you'll kind of see where I'm going with this as we go. So let me see. So what I want to do right now is I'm going to move this off the screen, and I'm going to bring up a chart. And this is a traditional divergence that we're going to look at. Just a traditional divergence. T1, I call that a T1 pattern. It's just easier to say than a traditional divergence. So what I did was I went way over and I just marked all these things. It's real easy to do. It only takes a couple minutes. So I just started right here. So what it is if you've got a double top, and your momentum tool is sloping down against that double top, then that's a divergence to sell. Okay, so you'd mark that as a sell. And then for our simple purposes today, if that goes 10 ticks, which is easy to see, does it go 2 bars before it is successful? The answer on this particular one is no. So what you do is you just just take a sheet of paper. I'm going to show you this in a minute. Just take a sheet of paper, draw a vertical line, W on the left, L on the right, and you put a slash for loser on this guy. Okay, then you get a double bottom or better right here, and you pick up another T1 right there, and it fires right there, and it's another loser. So you tally another one in the loss column. Okay, and you get another one right here. So price is going like that, or it's going level, and this guy's going down, and you fire that, and it's another loser. Okay, so now I got 3 strokes in the loser column. Oh, I got another one here. Oh, this is looking pretty bad for a traditional divergence pattern, right? I'm going to tell you why in a minute, why that happens. So here's another one. That one fires as another loser. Okay, another traditional divergence pattern. Okay, we got a winner, so put a slash in the W, and then you just keep going through the chart. Just keep going through the chart. So what I did was I did this for, I think, 11 days. You'll notice also you get caught in some nice ones. You get caught in some nice ones. This one was successful. Is it two continuation bars? You get a lot of trapping in these kinds of things. You get kind of trapped up. Now, years ago, a guy named George Lane popularized this kind of method, and a lot of people know what this is, which is why I used it for this example. And so when I tally this up over 11 days, and you could do it for longer, but when I tally this up for 11 days, let's go take a look at the result that we get. And, how long did it take me to do that? For 11 days, 6-7 minutes, and then I go back. I don't tally them at the same time that I do it. I just go back and I just slash, and then that gives me the opportunity to see if I made any mistakes. So I ended up with 17 winners and 17 losers, is 50%. Just simple stuff, right? So, if you're coding up divergences, in Bloodhound, well, be careful, because one of 2 things is going to have to happen here at that 50-50, because you're on the Gault and Board right here. That's right on the money, right? We've been looking at that. So one thing or another is going to have to be true in this particular case. Number one, you're going to have to be psychologically cool with winning only 50% of the time. Okay? If you can't handle winning only 50% of the time, then you're going to be, panic attack when you click the button and all this other kind of stuff. So, so the only thing that's going to save you in this particular scenario is that your average winner is way bigger than your average loser. That's the only thing that's going to save you. Your average winner's got to be bigger than your average loser. Otherwise, this is going to be psychologically tough to deal with. So, while you're doing this, you can imagine, oh, well, what would it feel like to only win 50% of the time? What would it feel like to get nicked and nicked and nicked? Am I getting, as I scan through the chart and tallying this thing up, am I getting caught in a lot of really big kind of runaway trades? Because if you are, maybe that works. Maybe it works. But for me, I like stuff that's higher than that. What is that level on the standard on that graph that we looked at a few minutes ago? This guy, 68%. As a general rule, I don't want to touch anything less than 68%. That's just my personal thing. I don't want to trade anything that's less than 68% win rate. That's just the way I roll, baby. So let's look at another one. This pattern that I'm about to show you, I've done in a lot of the webinars in the past. I call this the T2 pattern. Okay, I call it the T2 pattern. T2 pattern is instead of going against the trend like it did on the simple divergence that we just covered, this one goes with the trend. This one goes with the trend. So I just went back. And if you want to learn this, we teach this in our room, or you can look it up. Sometimes I call it a reverse divergence. So here you get this thing. This one, that's probably the same trade we had before, or no, it wasn't. It was a different one. So here, what you have is if you cycle down and you cycle back up and you're double topping, and this is higher, that's a form of the pattern. So you'd mark one up in your win column for that guy. Okay, this is A, B, C, D coming down, comes back up into there. You get this guy, and boom, 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 boom. Okay, this will get A, B, C, D going up. Price trend is going up. It comes back down. and this is going lower while that's going higher, and boom, boom, boom. And then this one, you get a nice long leg right here that comes up into here. And by the way, these background colors are coded in Bloodhound. It's the backbone. I don't do anything without Bloodhound. That's the backbone of my triggering system that's based on analyzing all different kinds of metrics in order flow and telling me whether or not the order flow is going with me at the time of my trade. So I just code that into a simple background color change in Bloodhound, and it makes it real easy. I can see, yeah, I triggered there. Did I go 2 more bars minimum? Yes, I did. Okay, it's a manageable trade situation. Okay, so this comes down like this comes up like this is higher than that is over there, while this is lower over here, and boom, boom, boom. Same thing here, boom, 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 comes up, this comes way down, and boom, 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 right? Now, you can already get a kind of sense that the not only are you getting a win percentage that's really high if you tally these things up, but you're getting trades that run for a distance. So this comes up again, another leg here, and this is coming lower right here, and that's a buy right there. Right? Oh, here it does it again, coming up, and it's lower, and boom, 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 boom. Okay, so lower, okay, boom. Ah, man, we found a loser, right? Found a loser, okay. Coming down, A, B, C, D, E, it's all going lower, and this guy's higher. Okay, boom. Ah, that's a loser. That's a loser. By the way, when you do this, you got to just like be absolutely nasty about it. You got to be nasty about it. Okay, A, B, C, D. This one comes back, touches into there, double top. Got that guy coming way up there. Okay, boom, 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 boom. Right. You just tally those things up. And so let's go take a look at that guy. And you got to be nasty about it. You're not going, oh yeah, I would have done this, I would have done that. No, you're not doing that. I did that for 15 years, right? No, you're not doing that. You're not, oh yeah, I would have done this, I would have done. No, you wouldn't have. Because in the worst case, you're going to screw stuff up. You're not going to make it better, usually, unless you're real skilled, okay? You'll make mistakes. You're like, oh man, that's set up and I missed it, right? Stuff like that happens. But if you just tally these guys up, I got 24 wins, 7 losses, 77%. 77%. You can kick the win percentage up like this if you find traps in the order flow inside the structure. But that's another story. And I've done webinars on that in the past. So let's go look at one more, just to kind of cement it in a little bit. This one's what I call the 3 higher dot, 3 lower. By the way, there's more to this webinar than just, you can use these patterns in just about any market. I call this a 3 higher dot, 3 lower dot pattern, okay? This one's so easy to see. So this was the divergence that we did before. Oh, what happened to all the price? This is the divergence that we did before, but we're not doing it with momentum. We're now doing it with order flow on this tool. This is showing me the order flow. Okay, so it's a very different animal. So let me just cover for a second. This tool right here shows us that the cycle's expanding. The whole one that we just did shows me the cycle's expanding. That means the market's going to trend. It's actually predictive of trend. That's what this whole thing's about. This is analyzing the cycle length, and it'll go opposing to the price when the price is trending. And so it's a very, very powerful tool in that way. But this guy right here takes about 7 or so different order flow metrics and shows them to me on the screen in a simple way so that I'm not watching things like ladders. I got 40,000 numbers and lines all over my chart. No, it takes all that stuff and it just narrows it down to one simple thing. But so what this one does is, without regard to any of the price action or anything else, do I get 3 lower dots? Yes, I do. Okay, so it's a loser. That's okay. A lot of times you'll get this kind of wedging pattern. 3 higher dots. Okay, boom, 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 boom. Right. Okay, 3 higher dots. That's actually was 4 higher dots. Okay, boom, 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 boom. Right. Okay, tally up a loser and a couple of W's. And okay, 3 higher dots. Boom, boom, boom. I'm doing this without regard to day or the time of day or anything else. Okay, 3 lower dots. Okay, not a loser, right? In general, this one over a long period of time is 68% successful. There's a loser. There's a winner. Sometimes these work a little better at different times of the day. Okay, 3 lower dots, boom, 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 boom. 3 higher dots, traps you. 3 higher dots, traps you. 3 higher dots and gets you caught in a monster. Okay, 3 higher dots, kind of traps you out a little bit. Either way, if you fire a trade like this, you ended up firing it at the high up in there by the time it triggered on the background color change, right? And so, you know, you filter some of these things in different ways. You have different rules. And then like I said, we're going to get into some conditional probabilities. Okay, 3 lower dots. Okay, boom, 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 boom. 3 higher dots. Okay, boom, boom, boom. Okay, boom, boom. Come back in. Boom, boom again. This one I call a TTO Trap Trader Oscillator V pattern. It's another pattern, but we're not going to cover that one today. Okay, 3 higher dots. Okay, boom, boom, boom. Right, and then just tally these guys up. So, you know, so you can use these patterns, 3 higher dots and T2. And so let's go back and look at some of the, so what did we do? We didn't use any kind of like statistics and standard deviations and all this crazy stuff. We just went and counted up the success of an extremely simple pattern. I think this, yeah, this one, well, what'd I get? 24 and 11. That's like my chicken scratch there. 24 okay, 24 divided by 35, 69%. 69% on that one. Over a long period of time, this guy is 68%. 68%. So, kind of cool, right? Just tally them up, and then when you fire the trade, you're like, I know this guy's 77% in my favor. I know this guy's 68% in my favor, 69%, something like that, right? Life is good. Oh, this guy's 50%. Sometimes these things work out nicely, but be careful, right? Be careful, be careful. So this is the actionable difference between winning patterns and those that aren't so great. Now, here's what's interesting. These patterns are extremely simple. They're always just really simple little stuff. And the longer you watch the charts, the more these things start revealing themselves to you once you start looking at this kind of stuff. It's just price action patterns, order flow patterns, and momentum patterns. There's three types of them, right? So this is a way of breaking your trading into a chunk where you got a known win probability over a period of time. By the way, if you're doing this, I want you to have at least 20 to 30 in your sample. You notice I didn't just do this over 5-6 days. At least 20 to 30 or more. And the lower the win percentage is, the more you need to do. The more you need to do. If you're hitting like close to 80% or something, you know, a sample of 30 is okay. You know, if you're getting like 50%, you could have to do hundreds and hundreds of them before you knew it was okay. So now that you have found some good reliable patterns to trigger on, let's take a look at some ways to make the most of it and some of the key issues that are involved with it. So first off, what we're keying in on here is a form of simple visual geometry. Geometry works because that's the way nature works. Did you ever look at, you know, it's like the whole mineral world is made out of geometric structures, crystals, and, you know, they call them crystals. But then, like, if you take a class in biology or something, you know, then okay, all these atoms start combining themselves into these different kinds of molecules, and they have a shape, right? It's like geometry. It's like the whole foundation of the way nature works. So, like, when we're using geometry in our trading, you're working with something that is foundational. very foundational. It's not abstract. That seemed a little abstract to me, Rob. Well, yeah. But you know, you got to learn to see these things. It took me a long time to learn to see this way. It took me a long time to learn. Well, mostly in finding the patterns, because what happens is after you do it for a while, you're just like, man, I've been looking at this chart for like 10 years, and suddenly this pattern just pops out in front of your face, and you're just like, whoa, what? Man, I never saw that before, but it's been in front of my face for 20 years. Oh, yeah, man, go back and check over the charts, tally it all up, and you're like, holy moly. It's right in front of your face, but you can't see it. That's a whole nother webinar on how you can't see what's right in front of your face. Form the basic geometry. And then we looked at a simple metric, just tallying it up, of how well it works within a given framework, right? Simple. We did one with the smart momentum, and we did one with the trap trader oscillator. These are tools from Indicator Smart, our sister site. So nature is based on geometry and probabilities, so why not trade that way? So that's what we did. We took a geometry, and then we applied a probability just by tallying it up. Okay, how often does it go this far or that far, right? Now I could get more sophisticated with the this far or that far. I could say, you know, I could tally up, well, how far did it go? It was a maximum favorable excursion. In fact, NinjaTrader has a nice feature on the back test for average maximum favorable excursion and average maximum favorable or adverse excursion and favorable excursion. Those are powerful because those can tell you if you're looking at if you're looking at something that's 50-50, but the max favorable excursion is 3 times the adverse excursion, you might have something that's actionable, because that's what we want, is something that's actionable, right? So we use these two indications because they work, and what I'm meaning is the smart momentum and the trap trader oscillator. One's based on order flow, and the other's based on cycle expansion and contraction. And those work in lockstep with price action and market geometry. So all this stuff like ties together into a nice little bundle. So the smart momentum takes advantage of the ability to predict range and cycle expansion, while the trap trader oscillator can show us where dumb money's trapped on the wrong side of the market. Now that wouldn't necessarily be the case like with a 3 lower or higher dot pattern. But I just use the 3 higher dot, lower dot because it's real easy to see it. Real easy to see it. Okay. So that's 3 things: price action, cycle expansion, and trap traders. Puts 3 things in your favor. So what you're doing when all these things are in alignment is you're stacking. Now in a few minutes we're going to look at a spreadsheet that shows you the stacking principle in another way. But when price action, cycle expansion, and trap traders are all lined up together, that's why you're starting to get these high win percentages, because all those things are working together. And so when you find something on the chart where all these are happening together, then you start getting in probabilities upwards of above 80, 84, 85, 86%, sometimes as high as 89%. And then I'm going to show you something after that you can add to this and even get win percents that run up into the high 90s, at least theoretically over an interval of time. So we'll look at that in a minute. Successful trading patterns are found through observation and not through backtesting. So this is a big deal. You know, when I first got my first trading software, you know, you just go run all these data optimizations and you go, oh yeah, man, I just found this really great system. Well, it always fails as soon as you start trading it, right? Well, why? Well, because it's not based on this kind of lockstep principles, structural things that we're talking about. It's based on just trying to find a pattern in the data. So if you establish the pattern first, and then you do the statistics second, pattern first, statistics second, pattern first, statistics second, right? Kind of just cement that into your mind a little bit. Pattern first, statistics second. Don't do it backwards, because it's well, I'm going to say it here in a slide here in a minute, so I'll leave it to that. But so this goes hand in hand with the idea trading methodology must be based on something that has a basis in fact, and not just on statistics alone. So there has to be some structural thing, and then the statistic, and then statistics are secondary. It's just another way of saying it. So pattern or geometry is first. This is why people develop trading systems using trading system software based on data mining. This is just where you're going through the, oh yeah, the stochastic is doing this and the moving average is doing that. And they often fail immediately. And for me, they fail even more. I start losing, if I decide I'm going to trade that system, I start losing money before I even take my first trade. Ha ha ha, just being funny. So this is an interesting thing. It is more likely that you will not find a successful trading system by data mining than it is that you will. That's that's an extra of that in there. It is more likely you will not find a successful trading system by data mining than it is that you will. And when I say successful, we're talking about the future right there, right? Talking about the future. Oh, it might look great on the thing, but it's the future that we're concerned with. It's the future that we're concerned with. So we got to do something that results in future success, right? So in this scheme, pattern comes first, coding comes second, statistics comes third. The order of the components that makes a successful trading methodology. So that's a structured chunk in itself, right? So it's important to construct the trading system out of components that each stand on their own. So, okay, I've got a T2 pattern that stands on its own. Well, maybe I got another pattern setting up at the same time that stands on its own, okay? And then those things will combine, right? It actually increases the power of the pattern, and when you have multiple of them lining up at the same time. And so, but the important thing is each of the patterns is simple and it stands on its own. It's an entirely different pattern than the others. It's exploiting a different thing. Another way to describe this is, it's like, okay, I'm going to design a trading system and I'm going to put stochastic, momentum, CCI, you know, all these indicators are really just doing the same thing. They're just variations on a theme, right? And so if all those line up, you really only measured one thing. You haven't gained any. And you could actually use the spreadsheet that I'm going to give you later to determine how much one is lending to the process and subtract it out. But that's a little bit of an advanced kind of thing. We talked about that in our trading room a couple days ago. Excuse me. When you combine components together that each stand on their own, then if one of them fails, the system will still be robust. The system will still be, it'll still hold together. It'll still have its power. Oh yeah, maybe it lost a little part, but it didn't lose the whole thing because the system was designed as chunks that each stand on their own. Simple, statistical chunks that each stand on their own. So if one of them fails, well, then what will happen is the stat will roll off, and you'll just go, oh, well, I don't need that component in the system. Then if it starts working again later, you can add it back in, or add in new ones that are coming on the radar, right? So if you combine the components together, components together that do not stand on their own, or that are related in some way, it'll actually decrease the probability the system will be successful going forward. When you first start designing trading systems, this is a big one. So if the math of the components that you're using are similar, then that can be a problem. It can be a big problem. So so this topic really, it relates to past, present, and future. And that's, you know, discerning those things in this process is real important. And what am I saying there? These elements are put together in the right places and they're interpreted back into the right places when you actually do the trading. So what I mean by that is a lot of times you can do some testing. That's why I show you these charts with these triggers on the background, because otherwise you don't. You need a decision to carry you into the trade on these charts. The background color changes from Bloodhound help carry us into the trade. This can seem less apparent than it actually is, so you got to be really, really careful. Got to be really, really careful. Sometimes you think you've got something and you don't, and then you got to make sure it's meeting the minimum requirement to create a manageable trade. So to recap, the probability of not finding a good trading system by doing back testing is extremely high. Not extremely high. The probability of finding a successful trading system in the future tense based on back testing alone is extremely low, and unless these structural guidelines that we're learning today are followed, the probability of failure, in my experience, is really high. There's this saying in the business, you know, past performance is not necessarily indicative of future success. I have here, finding a good back test is more likely than not, but it's not necessarily indicative of future success. So getting that thing that predicts into the future using the principles that I've shown you here will really help you a lot to do that. So you can go a step further and use different kinds of analysis to ensure that an equity curve in the future will remain the same. This methodology is called repeated measures analysis. And that's a method of analyzing the difference between different equity curves. So like you test different parameter sets. You know, it's like, okay, you got the moving average on 8, and then you change the moving average to 12 and get the test for that. Excuse me, and then you can drop those two equity curves into a spreadsheet, and you can just do a repeated measures analysis on them, and it'll tell you if they're different or not. This method of testing is really nasty. It's really, really nasty. I'll show you an example of what I mean. Just kind of as a side note here. You have an equity curve that's kind of like this, you know, over time, you know, oh, it's a winning system. And then you'll have another, you'll use the 12 period moving average instead of the 8, and you'll get something that looks like that. And you key that into a repeated measures analysis and it says, is this equity curve here statistically the same as this equity curve here? And the answer comes back yes. And you're like, oh no, this could easily be a losing system. It's called repeated measures analysis. That's a little bit beyond our scope. But your this is a really powerful way of testing. Just dropping in and using your in Excel, you can use your chi-square test. Will do that for you. But you can use in the summary statistics in Excel, you can do something like that. So pretty simple to do, actually. It's really rare that I've seen a trading system stand up to that kind of testing, unless it's based on, that's where I learned this stuff, really, doing repeated measures analysis, just doing thousands of them. And you start learning, wow, that thing that I just spent 20 years of my life trying to figure out how to do doesn't work after doing all these repeated measure analysis tests. So, but you don't have to do those if you're using the principles I'm showing you here in general. So, question is, how do you find the patterns first if you don't know what they are? Well, I've showed you a few of them today, right? So you can learn them in our trading rooms. And we're kind of maniacs about this. We've got just like tens of thousands of member hours into this kind of stuff, the geometric patterns and the patterns in the order flow and the patterns in the momentum, but it all reduces most of it down to just a few preferred patterns that have stood the test of time. You know, you got those patterns that just work over and over and over and over again, like that one I showed you earlier, the T2 pattern. There's a structural reason why that works, but that's a little too far to go today. So this is really enlightening when you get all this kind of stuff locked together, and it opens the door for trading systematically with known outcomes in advance. And it kind of helps with the whole psychology of trading. You still lose and you still make mistakes and all that kind of stuff, but you know, trading's always a work in progress, and it's hard work too. So that's why I say I don't recommend you go to a place like this unless you're really impassioned about it. It's got to be a work of love, you know. But I can tell you this, if you do go down that path and you are passionate about it, it's one of the most rewarding things you can do in your life, because it goes way beyond trading and into everything you do. That's nice. That's what gets me out of bed in the morning. So summing all this up in another way, if you do your trading in alignment with the nature of reality and in the way reality forms itself, then you're likely to be successful. If you don't, you know, if you just go do data mining, then you're in that part of the curve, that 68%, where things are kind of random. And if you do that, the probability for failure is pretty high. I don't say that to scare you or anything, but just to help you to get on the right path now. So another concept that's important in system design and trading is when you're in alignment with these principles of nature and just keeping it simple with just simple geometries and things like that. So I've never seen a complicated system in like 20 years of testing. I've never seen a complicated trading system stand the test of time, because some of the components are going to get out of sync with one another. Sometimes the components will actually keep you from trading. So, you know, if you got the stochastic, the momentum, and the CCI all in the same thing, and you require that they all be true in order to fire the trade, it'll keep you out of a lot of really good trades. So it actually, that kind of system design can really stack up against you. You actually end up coding something that's not going to work because you didn't keep it simple. So it's always the ones that are simple that work in the long run. Usually just like, you know, can be reduced to a couple of lines of code. So let's cover what you can do with some of these statistics. You know, we got the T2 pattern on its own. It was a 77%. We had the 3 higher dot, lower dot pattern was like 69%, right? So we know those. By the way, those numbers stand at that or better over really long periods of time. So I'm going to introduce to you what's called a Bayes spreadsheet. This is just my own personal copy of it. And I apologize, guys. I got something going on with my throat that's a little challenging. So, this tool enables you to take several measures that might be true at a given time and see how they combine to increase your success or to count against it. We'll look at some examples for that too. And so at the end of the webinar, I'll get you a link to the spreadsheet so you can start playing with it. But you can learn a lot by messing around with this thing. So there's two basic kinds of trading signals, those that push and those that pull. And the ones that pull, sometimes those will be targets. Sometimes those will be targets. So for these, the current price is not in the region of the target. That's what I was talking about, a type of confluence that has a spread on it, right? So the current price is not in the region of the target. And then we've got ones that push, that are in immediate contact with the price action. And those are pushing it towards or away, depending on the context. So you got one, and nature's designed this way too, right? Everything in nature's got its opposite. Okay, if you got a high pressure zone, in the weather, it's going to create a low pressure zone someplace else. Or if it gets super, super hot where you live, the air will start columning up. And that'll create these vertical clouds. They're called thunderheads. And it'll bring in rain. Why? Because that hot air is going up. It's drawing in cool air below it, right? So one's pushing up into the sky, and the other's pulling the cold air in. That's just one example. We could talk about that all day. One side pushing, one side pulling. So the ones that pull are often called targets, and yeah, so we got all this. So let's take an example. We might have what's called a double T2. That's where you get a T2 on both the smart momentum and the trap trader oscillator. These guys, we learned the first part of it earlier. The second part of it, you add that other thing. And so those combine to about 84% probability. And so, but let's say we also have a target that's within a reasonable range that we know is going to be hit at, say, 80%. For example, so when you open in market profile value area, like we did today in crude oil, for example, we know we're going to hit the prior day's range extreme 78% of the time. If you open inside value, you're going to hit the prior day's range extreme 78% of the time. Well, sometimes that's like 40 ticks away. That happened today in crude oil. You could go look at the chart. Open in value, and we took out yesterday's high today. That'll happen 78% of the time. So if we combine these two independent, uncorrelated factors together into our spreadsheet, so let's count it up. We got 84 and we got 78, right? So I'm going to pull the spreadsheet over. Here's my spreadsheet. So we had 84 for the double T2, and we have 78%, and that gives us a 95% win rate, right? The way when you get this sheet, you can see the formula is all right in there. And you could look that up on Wikipedia. It'll show it to you too. It's just called Bayes' theorem. So I can't even spell. Bayes was a Presbyterian minister, and he messed around with this kind of stuff, and he came up with this whole method of statistics. It's based on reality. What do I mean it's based on reality? Well, we went through and we counted it up, right? It's just simple. You count it up. Oh, 140,000 cars a day go by on, Interstate 5. you know, in my community. And it does it, you know, very consistently, right? So you combine those in, you get a 95% win rate. Wow. Now, once you've gone, we only tested that first one to 10 ticks, right? So once we've gone 10 ticks, it's not a guarantee that I'm going to go there, but this is helping. It's helping. It's supporting the trade. So, you know, you don't want to miss these guys. You got to take that. Let's look at another example. Imagine we have two simultaneous signals where one is 68%, like in the 3 higher lower dot pattern that we looked at earlier, and the other is a double T2, 84%. Okay, so we got 68 and 84. 68. That's 92%, right? Right there, 92%. 92, right? So then, taking that a step further, bring this back here, what if we also have a target at 80%? We haven't hit the, you know, we open in value and we haven't hit the high yet, that particular case. Oh, okay. Okay, put 80 in right there. What do we get? Ooh, 98%. You got to take it. You got to take it. You got to take it. Now, let me clarify. This 98%, that's great. Okay. But what's the probability that I might not be, you know, these two guys are pretty good. That one's not as sure. What's the probability that, and now I got a probability of my probability, right? What's the probability that the number I'm keying in could be wrong? And I could actually use the sheet to show you. Oh, if I've got, you know, let's just do this. Oh, if I've got something that's 78%, and I got another one that's random, I still get 78%. So what does that tell me? It tells me even if the number that I'm inputting has a random component to it, it's still worth doing because it doesn't take away. It doesn't take away. In fact, I can't draw that 78 down to a 50% win rate until I get to 22%. That's why as these win percentages go high, as we looked at earlier, you start stacking stuff in your favor in a really powerful way. So let's look at one more example. What if we have a signal that just triggered at 84? Or we have a signal whose minimum stat has not been met yet, and then you get an opposing signal comes into effect. Ooh, right? Now I got something going against each other. Okay, well I had 84, and then I've got another one that's say 84 that's opposing the other way. In other words, the market's in consolidation. The market's in consolidation, and I've got 84 on one, and then I have to, once I get the other one and it's going against it, it's only 16% in my favor. It's 100 minus 84, 16%. What do you think is going to happen? Random, right? 50-50. And this happens sometimes. You fire a trade, and then while you're managing it, another trade sets up in the opposing direction. Oh no, right? That's usually in consolidation. So this thing becomes a consolidation indicator too, because sometimes those things, you'll be seeing you've got multiples at the same time and you're stuck in a range. So you don't really want to trade random. You don't want to go back to that random 50-50 thing. Because you just don't, you know it's going to go one way or the other, but you don't, you don't know. So, you make an intelligent money if you're in, you make an intelligent money management decision. If you're not in, stay away because you're in consolidation. So the market is more likely to consolidate in these situations because it can't find a majority of smart traders. Can't find a majority of smart traders. I'm running a little overtime today. I'm blabbing too much. So I'm gonna send this into a little bit of hyperdrive. So I didn't realize I'd prepared too much material, but these are good things for you guys to know. So let's look at probability walking. A probability walk table is something that I developed, and it enables you to look at the market every 30 minutes and tells you what it's going to do, or what it has done historically is a more accurate way of saying it. But I can also key these into my base sheet. There's a 3-period probability walk table. I use it in the oil trading room a lot. And so what does this tell us? Well, -2 period, see that these little boxes on the chart tells me what time of the day it is by a number. So it doesn't, I don't have to use time. I can say, oh, it's -2. So what this tells me is, if I go -2, -1, A period. Well, so -2, there's -1. -1 went higher right there. That tells me 87.5% that A is going higher. Right, what's the next one? -1. So on A period, we've got A period right there. Once B takes out the low of that, you can see that little box steps out below right there. Once B took out A, it tells me 68% that C will go lower. 68.75 right there. But it also tells me that that A high is protected at 100%. Once B takes out that low, A high is protected. I call this the protected column. This is the extends column. This is just, you look at this every 30 minutes. Look at this every 30 minutes. So once C took out the B low, it told me that the D would go lower 75%. 75%. So this goes C, D, E. That tells me that E will go lower 75%, right? So this one is C, this one is D, and this one is E. This one is C, this one is D, this one is E. Tells me that once D goes below there, that this guy's going to go lower 75% of the time. So you can just key these things into your base spreadsheet also. Well, that's kind of cool, right? Every 30 minutes, just kind of tell you what's setting up. If these are setting up opposing some of the signals, like in some of the examples that we did, you can use that to keep yourself out of conflicted situations where the majority of traders aren't in agreement. That's what it's telling you when that happens. So, so you take all the above methods and it'll tell you where the majority is net long or net short, where they're thinking that, just in general. So that's kind of like trader, the psychology of the market all summed up into a couple of different things, right? So how do you get caught in runaway trades? I'm just going to cover this real quick. This is just simple stuff. It's just money management, right? So you got a 84% plus win percent. How can you manage to get caught in those runaway trades we talked about earlier? Well, we know it's good to 10 ticks. So we know it's good to 10 ticks. So, you know, if you're trading a couple lots, if you have that the liberty of doing that, if you're trading a one lot, my recommendation would be just trade the one lot and take off, you know, your $100, $90 at a time. And once you get some profits, you can add a contract, and then you can leave that extra contract on as a runner trade or a free trade. And what will happen is, you know, on any given day, you'll probably get caught in a 30-tick run, 25, 30 tick run in crude oil anyways, and sometimes you get 40, 50, 60 tick trades or even more. So, so if you need help or you'd like to tap into a long history of the kind of thinking that we've been approaching in this webinar, it's fun. I think it's a blast. And benefit from historically proven setups and analysis, then join us and learn more and get the system and benefit even more. There are many layers of learning available to you in our rooms, and it's best to join and keep it simple. Simple works. Hold on a second, guys. Excuse me. Oh, I just got some water. Excuse me. Which I have needed for a half hour, you can probably tell. What do I mean, keep it simple? Well, just pick one setup you like and just trade that. Just master it. Don't try and learn 40 things at a time. So just pick one thing and keep it simple. So, I got some special things for you today. Smart Patterns Trading System is what all this stuff is based on. The background color changes and the patterns and all that things that we've been learning today. We use that system in the oil trading room. You can key in black gold 199 as a coupon code at checkout and get a nice discount there. And you don't have to get the system. Most of our people who have the system joined the room and then got the system later when they saw that it worked, and I'm pretty proud of that actually. At Indicator Smart for the system, if you're interested in the system or system components to get yourself started, you don't need any coupon codes there. I got the lowest pricing ever right there. Indicatorsmart.com. Excuse me, indicatorsmart.com. And let's just take some quick look at some of the benefits of the trading room. So learn the price action patterns, cycle expansion, trap trader oscillator patterns, and get that into your consciousness, help you in developing systems and in your trading both that we talked about earlier. We got a lot of really amazing traders in the room doing their own statistics and everything else and bringing that to the table in the room, and they're sharing their insights and methods. Learn secrets of trends, targeting. Did some examples with some targeting today, but we actually have quite a few of these targets that hit with very high percentages, some in the high 90s. And range expansion. So benefit from the Smart Patterns trading system and its thousands of hours of member use and refinement. And also benefit from special content geared about trader psychology, which gets into like personal development and personal growth. We've already touched upon that a bit already. So that's what I've got for you today, guys. That spreadsheet that I promised to you, go to oiltradingroom.com/BT for Bayes theorem. Just oiltradingroom.com/Bayes theorem. And then if you want to get familiar, the videos on the Indicator Smart site also talk about some of the indicators that we did today and on some of their best uses and things like that. So let's see. Did we start this thing at, have I been, we're like at an hour and a half here. You know what I'm going to do? Let's do it this way, guys. Let me just scan through some of these questions real quick. You can use Bayes on NQ. You just got to find the patterns, Patrick. We have a stock index trading room. Those guys have all kinds of patterns for the stock indexes. SMO, Smart Momentum. Smart Momentum. Ticks, it's just the minimum movement in a market. For the market that we've been using today, it's $10 a tick, so 10 ticks is $100. Let me see what else we have. You bet, Patrick. There we go. Okay, yeah, that's just what we have. If you have any more specific questions, if it is, intriguing to you, join the room, you know, join the room. You'll learn a ton, and so you will learn a ton. Okay, guys, that's what I got for you. Thanks again to Ty and everybody at Shark Indicators. As Ty said, I've been with Shark Indicators since the beginning, over 4, probably close to 4 years now, and so it's been a really awesome thing. When I first saw Bloodhound and I saw, man, I can get all these things coded down into something that's not just expiring massive amounts of mental energy. I was like, well, I'm on for that. So, okay, guys, that's what I got. I hand it back over to Ty again. Thank you, guys, and indicatorsmart.com and oiltradingroom.com/BT. Thanks again, and we'll see you on the next one.
Awesome, Rob. Thanks for stopping by, man. It's always awesome when you present. Always educational. So much to learn. For anyone who tuned in late, we did record this, and we'll be sending out the replay link tomorrow morning, so just keep an eye on your emails for that. And everyone, have a great night. Enjoy your upcoming weekend.